Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, October 21st, just after the close. What's that? A Green Friday? You know, we have to go back, 5-6 weeks since the last Green Friday. And if we look at it even further back, 11 of the previous 12 Fridays were red. Why does that matter to us? We put a little bit more weight on the trading action on Fridays, specifically Friday afternoon, because it indicates how much risk traders, especially globally, want to take over the weekend. When Fridays get pounded week after week after week, it's indicative of traders not wanting to take risk. So it was nice to see a risk appetite come into the market today. Does that mean on Monday or Tuesday we're off to the races? Certainly not. But it's enough for us to put that into our puzzle and say there's a little bit of a different attitude today. In terms of what we've been seeing, you know, there's an old saying that, and I'm talking about equities right now, bear markets will either wear you out or run you out of the market. You know, we feel like we're getting worn out right now. And part of that is the extreme volatility we're seeing in the indices. We're seeing such extreme volatility that I wanted to share a couple of charts with you today. And they're from the folks over at Sentiment Trader, which is an outstanding website, gives us some research that we pay attention to. Again, as you know, sentiment is secondary to price action. But in terms of sentiment, look at this first chart. Over the last 2 months, more than half the days have exhibited extreme breadth. What is that? What does that mean? It means the number of days where greater than 80% or less than 20% of the New York Stock Exchange volume was up. So we're not parsing anything here. We're looking at up volume. It's either been greater than 80% or less than 20% in 50% of the trading days the last 2 months. That's an incredible number. What does that mean future-wise? Well, first of all, keep in mind, what do I always say? If I want to find something positive about the market, I can find it. If I want to find something negative about the market, I can find it. All we're looking at is pieces of a puzzle. But interestingly enough, extreme volatility in the form of breadth does tend to happen near bottoms historically in the market. Let's take a look at the second chart. What we're looking at here is the S&P 500. After half of the days the previous 2 months have had that extreme volume, what has been the post-action return-wise? Well, one thing jumps right out at you. Go back, two things do. First is, if I go back 60 years, there's only been 10 periods with this kind of extreme breadth. 10, 60 years. The second thing that jumps out at me is when we go back to old October of 21, October of 08, I'm sorry, which throws a wrench in a lot of trading statistics. If you look at the activity back in 08, and we'll use that 1021 figure that Sentiment Trader's using, you can see getting out a month, 2 months, and 3 months, 6 months, still a lot of damage. A lot of damage. Tough to look through that damage. Tough to ignore that damage. Keep in mind, that was at the same point where the banks were going under and the government had to bail out Citibank. Things are ugly. Markets have been ugly. I don't feel we're at that same scenario. I know some people do. Everybody has an opinion. Opinions make markets. If we can look through that scenario, returns have been fairly solid. And when I say solid, they get very impressive 6 and 12 months out. But what catches my eye is the limited drawdowns. If you look at the drawdown column, you see that your damage, your real extreme pain was somewhat limited after the kind of violent breath movement we've seen the last 2 months. And, we can come up with different reasons for that. Often it is, and I'll use a graphic word here, but it's what we use on the trading floor. You've had people puking out their stock. They've tried to hold on to it. They've tried to. And they've called quit on a number of days here. So, I try to go over things that can go right and things that can go wrong. As a matter of fact, that's a line I use almost weekly on our trading calls. What can go right here? What can go wrong? Plenty can go wrong. Rates can keep going higher. The Fed, which, you can argue that the Fed doesn't buy stocks for you or sell stocks, and that's dead right. But I will say, the Fed, as we mentioned 6-8 months ago, was behind the ball. And now with their realization of how far behind the ball, they're a wild card. And how that ends is yet to be discovered. So that's a negative. There's no bigger negative right now than Russia and Ukraine. I don't care what we feel the chances are of a serious incident. It's not zero. So whether it's 1%, 5%, 15%, whatever percent that is of a serious escalation over in Ukraine, that gets factored in. Those are problems. Those are headaches. But the market is reflecting these negatives. I sometimes I'm watching and reading people saying the market isn't reflecting the negatives. I don't know that they're trading the same market I'm trading. I see severe downside pressure. Now, fortunately, we've held some cash. I've been pretty consistent in relaying our cash position. Last Friday, we pushed some money into our U.S. core portfolio. I went over that trade. Traded, obviously, just fine this week. Interestingly enough, in our U.S. ETF portfolio, that's David's portfolio, got very aggressive this week. On Monday, took a fairly large 9-10% position in the banks. And midweek, we bought some small cap, just showing some positive relative strength versus the larger cap stocks. So we took a position in small cap. So those were 2 trades we had this week in the domestic portfolio. We'll see how they work next week. But again, try to keep an even keel, not getting too negative, not getting too positive, and we'll keep talking about it every Friday. So now we're going to toss it over to Patty Healy, who has some comments on fixed income.
Hi, I'm Patty Healy, Senior Vice President of Research at Cumberland Advisors, and it's shortly before the close. Well, it was a good week for Munis this week. They performed fairly well. Basically, their yields stayed pretty much where they were, while Treasury bonds increased. So by that virtue, they outperformed. The ratio of Treasury yields to Muni yields declined, or Muni yields to Treasury yields declined to around 70% from 80% on the 10-year. Although the ratios aren't as attractive, Muni yields still remain attractive. You can get 4 to even 5% or so on Muni bonds, depending on credit quality, sector, and maturity. But the credit quality of Muni bonds continues to be strong from record revenues, stimulus funds, and better budgeting habits. The calendar this week coming up is about $9 billion, so we'll see what the demand is there and how many issuers actually come to market, because sometimes they don't pull a deal because they're not happy with where interest rates go. Mutual fund flows, or give an indication of Muni demand, are still outflows out of mutual funds, but it's about $2.6 billion this past week. Lower levels than it has been, but we've had like 20 plus weeks of outflows. During this time, Cumberland has been selling bonds, maybe at a loss, but replacing those bonds with much higher yielding bonds as rates have moved up. These mutual fund flows can turn on a dime as soon as, and they have in the past, but as soon as people start buying muni bonds again, all of a sudden it seems like a herd follows, and you can go in very quickly. So you don't want to leave all your ammunition for just that one day, and you can't really tell when it's going to happen. But we think it's getting closer. So talking about a little bit about the Fed, everyone pretty much expects that there's going to be a 75 basis point Fed funds increase in early November. The December rate increase may, in fact, not be 75 basis points. Maybe it'll be 50 basis points. People are seeing some weakness in the market and hoping that, well, not necessarily hoping, but that the Fed may not raise rates as much. Late next week, PCE, which is the preferred measure of inflation by the Fed, is going to be released. So we'll see what happens with that. If market expectations are exceeded, then that might be a problem. Otherwise, maybe, well, we'll just see what happens with expectations for inflation. I wish you a very happy weekend, and we'll talk to you again soon. Thank you.
Thanks, Patty. Great info. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos or any intra-week updates we have. See you next week.